Good morning, and welcome to our release of second quarter 2022 performance results for FDIC insured institutions. The banking industry reported generally positive results this quarter amid continued economic uncertainty. Loan growth strengthened, net income grew, and most asset quality measures improved. Further, the industry remains well capitalized and highly liquid. At the same time, the banking industry reported a moderate decline in quarterly net income from a year ago, primarily because of an increase in provision expense at the largest institutions. This increase in provision expense, the amount set aside by institutions to protect against future credit losses, reflects the banking industry's recognition of risks related to persistent economic uncertainties and slowing economic growth, as well as the increase in loan balances. Net income also declined year over year at community banks. Unlike results for the industry as a whole, an increase in compensation costs led the decline in net income at community banks. Rising market interest rates and strong loan growth supported an increase of 26 basis points in the banking industry's net interest margin, or NIM, from the prior quarter to 2.8%. Most banks reported higher net interest income compared with a year ago. However, rising interest rates, longer asset maturities, and high levels of securities on bank balance sheets may present challenges for the banking industry in coming quarters. The deposit insurance fund balance was $124.5 billion on June 30th. That's up $1.4 billion from the end of the first quarter. The reserve ratio rose 3 basis points to 1.26% as insured deposits fell 0.7%. Despite several favorable performance metrics in the second quarter, the banking industry continues to face significant downside risks. These risks include the effects of high inflation, rapidly rising market interest rates, and continued geopolitical uncertainty. Taken together, these risks may reduce profitability, weaken credit quality and capital, and limit loan growth in coming quarters. Furthermore, higher market interest rates have led to continued growth in unrealized losses in the banking industry's securities portfolios. Higher interest rates may also erode real estate and other asset values, as well as hamper borrowers' loan repayment ability. These will be matters of ongoing supervisory attention by the FDIC. Now, as shown in this first chart, the banking industry reported net income of $64.4 billion in the second quarter. That's down $6 billion, or 8.5%, from the second quarter of last year. The banking industry, however, reported an increase in quarterly net income quarter over quarter. Strong growth in net interest income exceeded the growth in provision expense from the first quarter and drove a 7.8% increase in net income for the banking industry in the second quarter. Provision expense was positive for a second consecutive quarter for the banking industry and totaled $11.1 billion in the second quarter. The quarterly increase in provision expense of $5.9 billion reflects the industry's expectations of increased credit losses resulting from an increase in loan balances, slowing economic growth, and persistent economic uncertainties. The largest banks continued to drive the increase in provision expense from the year-ago quarter. Compared with the industry, community banks reported a more moderate decline in net income from the year-ago quarter. Net income for community banks declined $523 million, or 6.5%, from the second quarter of 2021. Now, our next chart shows that quarterly net operating revenue increased 6.2% from the first quarter of 2022 to $228 billion. Net interest income as a percentage of average assets increased from the first quarter, but remains below the pre-pandemic level. Non-interest income as a percentage of average assets was flat from the first quarter, as the growth in non-interest income was on par with average asset growth. Now, in this third chart, we see that the net interest margin for the 5 asset groups on which the QBP reports, the net interest margin for the banking industry as a whole, widened in the second quarter, increasing 29 basis points from the year-ago quarter to 2.8%. Despite this improvement, the net interest margin remains well below the pre-pandemic average of 3.25%. All QBP asset size groups reported quarterly NIM growth. The net interest margins for community banks also expanded, but by a smaller amount when compared with the industry. This next chart shows that the banking industry's holdings of longer-term loans and securities remained elevated at 39.4% in the second quarter. Although this higher level of longer-term loans and securities helped preserve net interest margins during a period of lower interest rates, this strategy has resulted in an increase in the level of unrealized losses on investment securities as a result of increased interest rate risk. Compared with the industry, community banks continue to report a higher proportion of assets with maturities longer than 3 years, which represent 53.6% of total assets. Now, this next chart shows the continued growth in unrealized losses on investment securities this quarter due to increases in market interest rates. Although growth in unrealized losses slowed somewhat in the second quarter, elevated asset maturities combined with a moderate decline in deposits underscores the risk of actual losses should banks need to sell investments to meet liquidity needs. This next chart shows that total loan balances grew for a 5th consecutive quarter despite the continued payoff and forgiveness of Paycheck Protection Program loans, or PPP loans. Loan growth for the industry exceeded the pre-pandemic average even without adjusting for the reduction in PP loan balances. The banking industry reported growth in several loan portfolios from the year-ago quarter, led by consumer loans, primarily credit card loans. Loan balances grew 8.4% from the previous year for the banking industry. That's the highest annual growth rate reported since the first quarter of 2008. Community banks reported a 7.7% increase in loan balances from the prior year. Commercial real estate loan portfolios continue to drive annual loan growth for community banks. PPP loan payoffs and forgiveness continued to limit loan growth rates. Excluding the effects of PP loan payoffs, the annual loan growth rate would have been 11.5% for the industry and 14% for community banks. The next chart shows that asset quality ratios for the industry remain favorable. The non-current and net charge-off rates are only slightly above historical lows. The non-current rate declined 9 basis points from the first quarter to 0.75%, driven by reductions in non-current 1 to 4 family residential real estate loan balances. Continued reductions in credit card and commercial and industrial loan net charge-offs supported a 4 basis point reduction in the industry's net charge-off from a year ago to 0.23%. Despite the improvement in more severe delinquencies, early delinquencies, those are loans past due 30 to 89 days, increased from the year ago quarter, driven by past due consumer loans. These early delinquencies could be an indicator of future asset quality risk and will be an area of supervisory monitoring. Community banks reported stable or improving credit quality metrics. The community bank non-current rate declined 4 basis points from the previous quarter to 0.51%. That's the lowest level on QBP record. The community bank net charge-off rate was unchanged from a year ago at 0.05%. But early delinquencies for community banks also increased from the year ago quarter, driven by an increase in past due consumer loan balances. Now, our next chart shows that non-current loans fell by a greater amount than the allowance for credit losses year over year, resulting in an improvement in the average reserve coverage ratio. The ratio of credit loss reserves to non-current loans increased from 177.9% 1 year ago to 203.6% in this quarter. This next chart shows that the number and the total assets of banks shows the number and total assets of banks on the problem bank list. The number of banks on the list is unchanged from the previous quarter at 40 banks. Total assets held by problem banks declined by a slight $2.7 billion to $170.4 billion in the second quarter. The number of problem banks continues to be at its lowest level since QBP data collection began in 1984, and no banks failed in the second quarter. This next chart shows that deposits declined for the first time since 2018. A reduction in uninsured deposits was the primary driver of the quarterly decline, although there was also a small reduction in insured deposits. Deposits totaled $19.6 trillion. That's down 1.9% from the level reported last quarter. While this reduction slightly offsets the unprecedented growth in deposits reported during the pandemic, total deposits are still well above pre-pandemic levels. This next chart shows that the deposit insurance fund balance was $124.5 billion on June 30th. That's up about $1.4 billion in the second quarter. Assessment revenue was the primary driver of the increase in the fund, offset partially by unrealized losses on available for sale securities in the deposit insurance fund portfolio, driven by the rising rate environment. Insured deposits decreased by 0.7% during the second quarter. Typically, insured deposit growth in the second quarter is flat to marginally negative. This year's second quarter decline is largely consistent with that historical trend, although slightly more negative than the historical quarterly average. Year over year, insured deposit growth remained strong at 4.3%. These factors caused the reserve ratio, that's the fund balance, the ratio of the fund balance relative to insured deposits, to increase by 3 basis points to 1.26% as of June 30th. This is 1 basis point lower than a year ago when the reserve ratio was 1.27%. The FDIC adopted a deposit insurance fund restoration plan on September 15th of 2020 that would return the reserve ratio to 1.35%. That's the statutory minimum by September of 2028 as required by law. During its most recent progress report to the board, the FDIC projected that the reserve ratio is at risk of not reaching 1.35% by the statutory deadline. In June, the FDIC amended the restoration plan and approved a notice of proposed rulemaking to increase initial base deposit insurance assessment rates by 2 basis points, beginning in the first quarterly assessment period of 2023. As mentioned, in the notice of proposed rulemaking related to the amended restoration plan, this would result in an estimated annual reduction in average industry income of less than 2%. These actions were undertaken to improve the likelihood that the reserve ratio reaches the statutory minimum of 1.35% before the statutory deadline, while reducing the potential for a procyclical increase in assessment rates should the banking industry enter a period of stress in the interim. The FDIC continues to incorporate recent data into its projections of the reserve ratio. The intent of the proposed change in assessment rates is also to further support growth toward the FDIC's long-term goal of a 2% reserve ratio, an important complementary objective. The comment period on the proposed rulemaking to increase assessment rates closed on August 20th, and we will carefully consider all of the comments received. So, in conclusion, overall, key banking industry metrics remain favorable at this time. Loan growth strengthened, net interest income grew, and most asset quality measures improved, despite a rise in early delinquencies. Further, the industry remains well capitalized and highly liquid. However, the banking industry continues to face downside risks resulting from prevailing economic uncertainties, inflationary pressures, a rising interest rate environment, and geopolitical concerns. These factors could hamper bank profitability, weaken credit quality and capital, and limit loan growth. These risks will be matters of continued supervisory attention by the FDIC over the coming year. Thank you very much, and I'd be happy to take your questions.
Hand feature and I'll call on you. Claire Williams at American Banker.
Hi, thank you for taking my question. I'm interested.
I'm afraid I can't hear the questions if they're being asked.
Can you hear me now?
Hold
Can anyone
on,
else hear me?
Not yet, Claire.
Okay, we're good. I'm interested in the diff and rise in deposits. I'm curious if, due to these results, that accelerates or changes your thinking on assessment fees going forward.
I'm sorry, I had a little difficulty hearing you. Could you speak up just a bit?
Sure. I am curious on the diff and rise in deposits. I'm wondering if the rise in deposits, as well as economic headwinds, including interest rates, changes your thinking going forward on assessment rates.
Thank you for the question. We had it's not untypical, as I mentioned in my remarks, for deposit insurance growth to slow a bit in the second quarter. But frankly, the year-over-year growth rate of over 4% in insured deposits is still very strong, and that was really the basis for the proposal that the FDIC board put forward for comment in June to adjust assessment rates upward by 2 basis points. We're reviewing the comments we received. We're continuing, as I indicated, to assess the data, and we'll reach a decision later this year on this issue.
Next question. We have Allison Bennett from S&P Global. Go ahead, Allison.
Hi, yeah, I just wanted to ask a question about the data on problem banks. I know the number hasn't changed. There was a decrease in assets. And can you tell me a little more about what that indicates?
Not much, I think, is the short answer, because it was a marginal, a marginal change that really wasn't reflective of any, I think, underlying or broader issue, quite frankly.
Hmm. Thank you.
Any other questions on Andrew Ackerman from the Wall Street Journal. Go ahead, Andrew.
I was wondering if you had a take on the paucity of bank failures. On the one hand, that's great. There hasn't been a failure in a couple of years, but do you worry that that's a sign of hidden risks building or anything like that? Thanks.
Look, I think it is a reflection of the underlying strength of the banking industry, and the industry has actually done relatively well over the past couple of years. And so we've seen few bank failures, but for the reasons I highlighted, looking forward, there are, as you well understand, significant economic uncertainties, a changing interest rate environment, a slowing economy, and that could have consequences, as I indicated, for the banking system. And that's something we're going to be paying very close supervisory attention to over the coming months.
Thanks.
Sure.
Next, we have Evan Weinberger at Bloomberg Law. Evan.
Hi, thanks for taking my question. You mentioned that there's some potentially bubbling up problems in consumer loans with the short-term loan delinquencies rising. Do you have any more color on what kind of loans are facing more problems with auto or short-term personal loans? What kind of loans are causing the most problems, do you think?
I might ask Pat Mitchell, who's the director of our Division of Insurance and Research, to comment on that. But I think on credit card loans, we're seeing is a particular focus there, and in a rising interest rate environment, that could present challenges for borrowers to meet their credit obligations, and I think we're beginning to see some consequence from that. But Pat, perhaps you'd like to comment further on that.
Sure. I'd agree with Chairman Gruenberg's comments there. It's really driven largely by credit cards. And again, these are early delinquencies. So these are, again, the 30 to 89 stage delinquencies, and it's starting from a low level. But again, it's at least an uptick, and so something that we want to keep a close eye on. But it largely is a credit card portfolio.
Okay, thank you.
Any additional questions on today's financial results? Not seeing any hands. We'll open the floor to any additional questions you may have for the chairman or Pat. Evan Weinberger at Bloomberg Law. Go ahead, Evan.
All right. Yesterday, Acting Controller Michael Hsu talked a little bit about climate scenario analysis and how the traditional stress test model and using that for climate analysis might hamper efforts to make sure the banking system is safe to climate change risk. I was wondering if you had any thoughts on how best, on his comments and, what your views are on climate scenario analysis versus stress testing.
Well, it's a tool that is going to be part of a broader effort to evaluate the financial risks associated with climate change. I think there's going to be has already been an effort begun by the banking agencies, and I think the three banking agencies, the Fed, the OCC, and the FDIC, are going to be working together to provide guidance to the banking industry on the financial risks of climate change. It's going to involve issues relating to the governance of institutions, to the management of traditional risks that banks have to deal with as they're impacted by climate, and potentially utilizing scenario analysis and stress tests as a tool to gain insight into the risks to individual institutions as well as to the industry as a whole. So I think this is of necessity going to be a broad effort to get a better handle on the financial risks that climate change poses to the banking industry, and to provide guidance to the industry on effectively managing those financial risks.
Okay, thank you.
Sure.
Almost at the hour, so we have time for one more question. Again, senior staff will stay on the line after the live stream to answer any additional questions about the financial results. Claire, go ahead.
I was interested in the cease and desist orders on deposit insurance directed at a number of crypto-related companies. Is that sort of the last we're going to hear of that issue? Is there more planned? And do you have any additional updates on that issue?
Well, the issue you raise goes to a core concern for the FDIC, which is the credibility of the deposit insurance system and the public's reliance on that system, which is really central to financial stability. And as you mentioned, we've had instances by a number of companies that have made clear misrepresentations in regard to deposit insurance coverage. That's potentially a violation of the law. We have issued letters demanding that these companies cease and desist. And frankly, we are continuing to review practices by other companies. And if we identify additional instances of misrepresentations, we'll be quite prepared to take action, because it really goes to a foundational concern of the FDIC.
We have one other question and still some time. Andrew Ackerman at the Wall Street Journal. Go ahead, Andrew.
Hey, thanks for taking my question. Sorry for the background noise. So I wanted to ask about about your predecessor. The Republicans have kind of attacked you, Chairman, for being part of what they've termed as a coup. The Justice Department came out with an opinion that sort of backed your side of things. I'm just wondering if you have reaction to the criticism and to this opinion that's come out.
Well, I will say I think the opinion pretty much speaks for itself, and it confirms the basic governance principle that a majority of the FDIC board may present items to the board for a vote and decision. And I think that's pretty straightforward. And I don't think I have any comment to add beyond that.
Thanks.
Thank you, everyone. That concludes our live stream. Again, we'll have staff remain on the line just to answer any other questions you may have about the financial results. And thank you for joining today's briefing.